Yeah, but you want to look for opportunity where it exists.
The math is the math is the math. And when bonds, as long as you're buying bonds, as long as your time horizon as an investor is longer than or as long as the duration of the underlying bond portfolios, the likelihood of ever actually losing money is very, very low.
Yeah.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber. Today, I have back for his fourth appearance, David Mitchell, now Managing Director at AllianceBernstein. We're going to talk all things economy, stock market, and bond market. We're going to be going through some things where we're going to reference some charts. So if you are a podcast listener, go to YouTube and watch this episode of the Guided Retirement Show on YouTube so that you can see the charts that we're referencing. Please enjoy my conversation with David Mitchell. David Mitchell, welcome back to the Guided Retirement Show. You were on about 6 months ago. This is now your fourth appearance on the Guided Retirement Show. And for those that haven't caught you before, go ahead and give your background and let us know who you are.
Well, thank you, Dean. And my background's actually changed or my resume's changed since I was last on. So I'm in my 19th year with AllianceBernstein, who in aggregate manages around $700 billion globally for every type of client you can imagine, right? Large institutions, pension funds, sovereign wealth funds, and then private clients here in the United States, obviously. And I am now the managing director for all of our RIA, so the Dean Barbers of the world.
Yes.
And private banks for the entire Upper Midwest Central Division. So I'm basically one of four, call it specialists, at AllianceBernstein in North America.
So you're kind of a big deal.
Hope maybe in a couple of years if we do this right, if we get some things right, but the potential's there.
Yeah. You've joined us in the past and we've talked all things political, economic, kind of where
thematic super cycles.
Yeah, where you guys see things from the perspective of the stock market, from the perspective of interest rates. And earlier in the year, when we had a conversation, you were thinking that there would be somewhat of a headwind for equities and somewhat of a tailwind for fixed income or bonds.
Correct.
And we've seen some crazy things happen this year, and I think the normal person just looking at the market would say, well, you were wrong.
Right.
Talk about why you weren't wrong and what people see isn't necessarily reality.
Yeah, no, it's a great question because I went back and listened to that episode because I want to make sure that I had everything front of mind. But you're right. If someone just took the two main indices that sort of every financial advisor or household anchors on, which is the S&P 500 for stocks and the Barclays aggregate bond index, which is mostly treasury bonds,
right?
But very high investment grade, AAA, AA. They would say, again, wow, that has not been borne out at least since April. But I would tell you, I think that there's a number of reasons of nuance and context to that, but the trajectory of a lot of what we talked about is still intact and is manifesting. But you have to peel back the onion a little bit. And so with stocks, what has been a bit different is that you've had, and I think you've probably alluded to this on your show, Dean, 7 stocks
right,
that have driven literally everything in the S&P 500. So if you look at, there's 2 different indexes, right? The S&P 500, what's called the cap weighted, which the top 10 stocks make up 30% of that index. And then there's an equal weighted index, which just takes every stock, all 500, and just equally weights them. The equal weighted index, which is kind of what we think, what should be kind of more of your typical stock return this year, is flat year to date-ish, up maybe 1%, which is where those top 7 stocks, your Apple, Microsoft, NVIDIA, a lot of the major mega tech companies that we know are up around 14 or 15% on average.
I just pulled it up while you were talking, and it is negative 0.69 as we speak on RSP, which is the equal weight.
Okay.
Yeah. So that tells you a lot about, and then you got like NVIDIA up 230% this year. That's driving a boatload of the return for the S&P 500.
Yeah.
It's cap weighted.
Yeah.
Right. So,
and then can I speak to bonds real quick too?
Yeah.
Okay. Because on the bond side, right, there's 2 different types of bonds. There's high investment grade treasury bonds, which is still a large portion, right? The U.S. Treasury is the largest, most liquid asset in the world. And that's why the bond benchmark, the main one, is flattish to negative this year as well.
Yeah, I think the ag is negative
1%.
Yeah, something.
However, there's a story going on within the bond market, sort of like the Magnificent Seven with equities, that high yield bonds, high yield corporate bonds, are up 5 to 7%. So have performed really. So it's a market that is much more, to use an SAT term, idiosyncratic in what's been delivering their returns or the attribution of returns than just the headline number.
So I have a question for you, and I know that there's no way that you can predict this, but if you're an investor right now and you want to deploy money into the equity market, do you buy the equal weight S&P 500 because you have so many more undervalued equities there, or do you buy the S&P 500 that is cap weighted?
I can only tell you what I'm doing with my own personal money, and I'm buying the equal weight. And I'm buying the equal weight because my financial advisor recently showed me a chart that I had not seen before, that since the equal weight has been in existence, has had an inception.
It's actually outperformed.
In 31 of 34 observations, we are living through, I think that was rolling 6 or 1 year windows. We are living through right now, this observation is the greatest that the cap weighted index, i.e. those 7 to 10 stocks, is outperforming the equal weighted index.
Right. It reminds me of 1999.
Okay. Yeah. Yep.
Right, when
I was still in school, but yeah, you tell me.
Well, but I mean, when every company that had .com behind their name was soaring and making the markets overall look good. But remember, back then you had the value-oriented stocks, or they called them the brick and mortars companies that were doing nothing.
Yeah.
And so all the money was flying there, and I think that's what's happening here with.
I think you're right as far as the concentration of the market. The only difference would being a lot of those companies in the tech run-up really weren't worth anything and eventually went away. And Microsoft and Apple are great companies, are going away. But are they expensive now?
Yes.
Relative to the rest of the market and to their historical price-to-earnings ratios? You could argue that.
Yeah. And some even more than others. Yeah. Tesla, NVIDIA would be two examples of that.
So going back to your question right now, and then looking from an industry standpoint, there is $6 trillion with the T assets sitting in money market or cash proxies, CDs. There are a lot of people, myself included, that have been sitting in cash. You can earn a return on cash now. Finally, right? If you're a saver, it's great. But I think are sort of looking for a way to deploy that capital in a way that makes sense for the next 12, 24, 36, hopefully longer term, time horizon, depending upon your individual circumstances. So this is a question of trade-offs that I think is universal right now in our industry, moving cash off the sidelines.
So there would be two places where you would go with that cash in a traditional asset allocation model. It would be either fixed income or it would be equities. And so when you think about what some people have been talking about, some of the big bond managers and economists and things, they're saying it's time to move out a little bit longer on maturity. Mm-hmm. And so talk about what that means and why you think that does or does not make sense.
So it's actually one of the biggest reasons why the Treasury market and investment grade bonds have underperformed this summer. I mean, the last 2 months coming into October, we've seen a little bit of a stabilization, but August and September were again two of the worst consecutive months for bonds going back to 1980, 81, or even last year. And the reason is that a lot of the folks like AllianceBernstein, the large institutional money managers out there, they started to recommend to clients back at the end of last year and early this year for clients to start to extend their maturities, to buy back what we call duration as our industry term. Because even if you can't get the timing exactly right, if you were looking out 12 to 24 months, as we talked about, the math on bonds with where yields as high as they were looked really attractive relative to the median stock. So one reason, and this I'm going to kind of tie this all together.
Yeah.
One reason that the bond market was down so much in August and September was that a lot of those large institutional money managers and insurance companies, et cetera, had already made that trade, had already extended durations. So there wasn't a lot of demand there to sop up these higher yielding treasuries as there might have been early this year or late last year. So it's what we call in the industry, it's a bit of a technical issue, but you ask me, so where does the demand come from now? If all the firms like AllianceBernstein and again, name your large entity, have already sort of maxed out their duration within their typical bond mutual fund, it's got to come from that $6 trillion sitting in cash. It's mom and pop next. So what is the catalyst? What is the spark that ignites that mom and pop retail investor sitting at, with Charles Schwab or whoever, pick your custodian, starts to move that money off the sideline and starts to buy bonds again? That will stabilize interest rates, and you're going to see it move very quick the other way.
Do you think that interest rates have to stabilize first? In other words, the Fed has to admit that they're done in order for that to transpire? Because I think what's happening right now is you're seeing a lot of people with the mindset of, I'm getting around 5% on my money market account. I haven't been able to get anything like that, and it's liquid every day. Why would I tie something up? You go out and buy like a 5-year treasury and you're under that 5% yield. But I don't think what people don't realize is that in order for you to get 5% in that money market, rates have to be the same place a year from now than they are today.
Year. So that's correct. So two parts to your question. One, I do think you're right, Dean, that the Fed will have to be, in their language, Jay Powell and team, a bit more explicit that they're done. That the job has been won, that they've conquered inflation. They're just, this is a whole nother pod, but they're just not ready to turn what we call their language a bit more dovish instead of hawkish, where they've been for a year and a half or more.
Yeah.
So I do think that would help. I think it would help, again, provide that, maybe the gasoline to that bonfire. So that's the first thing. I think the other thing will be, are all of my clients, like you and others out there, showing clients what you just said, that yes, you're sitting in cash right now, and that 5% headline number looks good, but two things have to happen. Number one, will that 5% exist throughout the entire next 12 months? And two, if you look at now the bond math return of moving to a bond fund, a more diversified basket of bonds, both maybe some investment grade, but also some higher yielding bonds, you're looking at a point now that when interest rates fall, you're going to be earning a total return, your income plus your price, in the double digits. So I it's going to take some sort of mass information, herd mentality to get folks to understand that this is the greatest potential return on bonds that they've had since the 1980s. Over a 12 to 24 month time.
Yeah, I think you're right. I mean, I do think that there's opportunity that we haven't seen in the bond market in a long time, and rightly so. I mean, if you just step back and say, okay, what's a bond worth? It's issued and it matures at par, and that par is 100. And so, you come into 2022 in January, and your high quality stuff was trading at 115.
The munis,
right?
AAA munis trading at 115.
Yeah, so they were a 15% premium.
Yeah.
So their yield to maturity was not very attractive.
Less than 1%.
But now you can build a good portfolio of munis near par.
Or
below
under,
par. Yeah.
Or below. And I always think with munis, which is another place that we think that just as a firm, pound for pound, the symmetry of the upside versus very limited downside, even if rates stay up, and I've shown you some math on this, are very good. But the thing that also drives me crazy about munis is that we don't consistently, I think as an industry, remind folks of the taxable equivalent return.
Oh, for sure.
So if you're in a high tax bracket, 35, 37%, and you're buying a diversified muni portfolio today with the average yield to maturity of around 5%, you're talking close to 9%. A taxable equivalent return. And so once you add a little price return on top of that, say the 10-year gets back to the mid threes next year, the low threes, which is our current forecast by the end of 24, you're talking a taxable equivalent total return of 14, 15% off the top. I mean, that is, again, we haven't seen that in decades.
Right. No, I agree. I think the muni market today, well, it really started being attractive about a year ago.
Mm-hmm.
And as interest rates have moved, you've had some times when it wasn't quite as attractive as it was.
Certain months better than others.
Yeah, but overall, it's even more attractive today than it was a year ago.
Yes, because again, what I love bonds. Again, I don't own many bonds because I'm in my early 40s. But I'm really contemplating owning munis at this point for a variety of reasons.
Well, with your taxable accounts,
right?
It
does make sense, even for me, who's maybe my retirement is in 15, 20 years. But yeah, the bonds, while the pain of resetting to higher rates is real because the price declines on paper feel real, ultimately, as long-term bond investors, you want to root for higher yields. Because the engine of a bond's return is that cash, is that coupon. We're fortunate that we're going to get cash plus % when the yields fall again here.
Right.
But just even if we hang out here for a while, maybe we are higher for longer. You hear that term now. It's like the economy stays strong, we avoid recession, the Fed doesn't pivot. But still you're earning really, really high returns because yields are just, again, they've doubled and tripled in many cases and under a very short period of time.
Yeah. Do you have that chart that shows if rates are 5.25 on the 10-year versus 4.7 on the 10-year?
Yeah, it is. It was where the 10-year was, I think, last week, and it showed that our worst case outcome right now, what we call the stagflationary scenario, which is we put odds of about 10% over through the end of 24. Stagflation means that we hit, inflation persistently stays too stubbornly high, so the Fed can't pivot, and at the same time, growth declines. So I'll give you an example of why you kind of hear this rumbling right now. What a stagflationary phenomenon is very high energy and oil prices, right? It's what led to contributed to late 70s recession because it hurts consumer, right? Rising energy prices, heating your home in the winter, right? So it forces you to move your discretionary income down because you're spending more on energy. But since it's an inflationary metric, the Fed can't help the consumer by cutting interest rates.
Right.
So that could be a potential problem. But even if that came to fruition, a very low probability, 10%, and interest rates happen to go another 1%.
Was this before the Hamas attack on Israel? Because I think that brings a new dynamic to the potential for that stagflation because we could have higher energy prices for quite a bit longer.
You could, but also you could. So this was before. This is a lot. What's great about our business scene, a lot changes in a week.
Yes.
But long-term math doesn't, right? The trajectories don't often change, but the path of how you get there can change. Volatility can change. Right. So, but let's say that came to fruition where energy prices stay high, growth slows, maybe we even do hit recession, which is a true stagflationary event. And let's say interest rates, the 10-year Treasury goes from about 460, 470 where it was to even 560, 570. Right now in a AA 5-year muni bond, your starting income is so high that your total return would basically be flat over the next 12 months.
Even if 10-year goes...
Even if the 10-year rose another 1%, which again is a very low probability event. Not nothing, has to be respected, but low. Conversely, what we put more of a 40% chance on, so sort of the house view or base case, is that the 10-year drops 1% and is back at sort of 350, 360. We have some folks at the firm think it can even be lower. Then you're talking an upside of 8%. Again, nominal, not even taxable equivalent. I'm just talking about the headline number.
Right.
The path to return in the equity markets. When I think about the risk-fee return or trade-offs between stocks and bonds right now, if you look at 2024 for the stock market, the bull case and the bear case are about equal. So our bear case is that the S&P, if you look at all the various scenarios, could be down 10 to 13%. In our bull case, our most constructive case, is that the market could be up 10 to 13%. Whereas bonds, I just told you, our bear case is that you're flat, and your bull case is maybe you're up double digits.
Right.
That to me, again, as a more seasoned investor, if you're depending upon your risk tolerance, it says, gosh, pound for pound bonds do still look really attractive. The path is questionable, but the outcome looks to be more certain.
Interesting. So give me your bull case then. What causes a 10 to 13% return next year?
The bull case is underlying inflation does continue to trend in the right way, right? You get these kind of one-off months anomalies where it was like medical spending last year And now recently it's been on services inflation, some stuff around airline tickets and hospitality or hotels, right? So a lot of folks that maybe are still traveling, especially folks that are upper income. So I think, but in aggregate, inflation continues to move in the right direction.
So down.
We stabilize kind of below that 3%. We get a 2 handle on core inflation, which is what the Fed continuously is unrelenting or unwavering in what they want to see. Some inflation in the 2s. We get there, and then what we said earlier in the show, that Jay Powell can finally come out and in his own way declare victory.
So if that happens, you get a bull case for equities and you get the same bull case for bonds.
Because what do we have in 2022 that we're still kind of coming out of is a bear market in both, which typically doesn't happen.
Right.
But typically, you own stocks and bonds in a balanced portfolio because they're offsetting mechanisms to each other.
So 2024, inflation continues to move down. Powell says we're done. And
earnings hold up. The economy slows but doesn't move all the way into a meaningful recession.
Okay.
Right. It's kind of that soft landing scenario, to use the term. Yeah.
Right. So you get that scenario. You get up for bonds.
I think you're up double digits in both.
Yeah.
I think you're up, call it 10, and then once you take into account taxes, 10 to 15% in both.
Now the stagflation, is that the bear for both?
That's the bear for both.
So it's higher energy prices.
Bear is in. I think stocks would be negative, and bonds are flattish, so they don't give you that offsetting diversification that you typically need when stocks are down. Yeah, I think it'd be really something now for bonds to have another bear market, because again, starting cash yields and interest rates are so high, so your margin for safety is that much more. I'm doing finger puppets.
I understand, yeah. but the other thing I think that you mentioned earlier, which I think it's important for people to understand, is that you can buy bonds at a discount today.
Yeah, and as long as that bond doesn't default, you're gonna eventually, it's gonna mature at par. It's gonna land at par.
Right.
So you have with certainty, and you can buy AA bonds at discounts.
Yeah,
doesn't happen very often.
Well, I reviewed with one of my clients who you all have an individual muni portfolio for this week, where the current yield's 4.8, but the yield to maturity is 4.9 because we've got some discounts within the portfolio.
Yep.
And that's tax-free.
Yeah. Yep.
And so, yeah, anybody that's in a high income bracket, I mean, I think that this is the first opportunity in probably a decade and a half that people have had in that tax-free environment.
Yeah, you'd have to go, but we've been running that account since 1991, and I haven't looked at the exact year, but the range is you'd have to go back to
go back to at least 08.
It was before, but yeah, I think it's in the mid aughts, right?
Yeah.
Kind of 04 to 06 range, where you've had a starting yield with some discounts in the bonds basically around par.
Yeah. And I think it would be interesting for people to understand what can happen in that environment and the sheer attractiveness of what's there, and in something that's very safe.
Yeah, well, especially munis. I mean, the muni market has one of the lowest default rates of any type of bond in the world, way higher than corporate bonds. And so you're right that again, the fundamentals and the muni market fundamentally is in a very strong place too. So I sound like a butcher selling meat here with munis, but
you want to look for opportunity where it exists.
Yeah, and again, I go back. The math is the math is the math, and when bonds, as long as you're buying bonds, as long as your time horizon as an investor is longer than or as long as the duration of the underlying bond portfolios, it's nearly the likelihood of ever actually losing money is very, very low.
Yeah. Yeah. I mean, you'd have to have mass defaults if you were going.
You'd have to have mass defaults. You have to permanently impair. You have to be in defaults and bankruptcies and
look. We didn't even see that in Puerto Rico.
No,
I mean there was a lot of talk about it years ago, but it didn't manifest itself.
Yeah, and we're more conservative. We didn't own any Puerto Rico, but we watched it with a lot of interest, obviously, and helped advise on some of the committees to help them come up with a rescue package. But yeah, and that was a definite problem child that that we were too scared to own. That we because of all the fundamental reasons.
Right. Well, it's interesting. I think that if somebody were an individual investor and they can kind of take what you're saying, okay, stagflation's our worst case scenario. That's minus 10 to 13 on equities, and it's basically saying we're flat on bonds. Best case scenario is
the soft landing.
Soft landing. Fed says we're done. We see a gradual decline in the 10-year Treasury. We get the 10 to 13 plus, and then we get the high single, low double digits on fixed income.
Be nice 2024.
Could be.
Yeah.
Could be. Well, we'll have you back on again, and we'll find out where we're at. You're one of the only guys that really comes on here to the Guided Retirement Show and really talks about fundamentals and economics and how it all plays out. So really appreciate you taking time, David, to come and join me here on the Guided Retirement Show.
It's always my pleasure, Dean. Anytime. Phone call away.
Thanks. Thanks again for joining me here on the Guided Retirement Show. I hope you enjoyed my conversation with David Mitchell, and hopefully this helped to make you a more intelligent investor.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Modern Wealth Management, LLC, an SEC-registered investment advisor.